Hey, welcome back. It's Barry Page with Legacy Money. And in this video, the second part in our video series on becoming your own banker, I want to help you determine how you will fund your own privatized banking system. We'll develop a strategy to help you finance your major purchases over your lifetime. This video series is not meant to be a substitute for reading the book Becoming Your Own Banker. They are designed to inspire you to take action. In my first video in this Infinite Banking series, you were encouraged to take action and apply for life insurance with a mutual life insurance company. In this video, we're going to discuss your strategy for funding your system. And at this point, I'm assuming you have read the book, Becoming Your Own Banker, and done some critical thinking on this subject. And you're now ready to build your own privatized banking system. If you are following along in the book, in this video, we'll discuss the spending patterns of the all-American family. You may or may not have been approved for life insurance at this point. Your agent, your practitioner, should be able to help you develop a strategy without getting too complicated in the numbers. What you should be focusing on now is how you will fund your system and a strategy for the long term. As Nelson stated throughout the book, this is to be a system of policies. So you're not going to get it all done with one policy. You have to think long term over your lifetime and the next generation or two or three, depending on if you want to develop a generational wealth strategy. This may be easier said than done, so don't get too caught up in all of the numbers. Just understand that you're building wealth for you and your family. And if you're a business owner, this is something that you'll be able to use in your business. You will probably own many policies. Some may be on yourself, some may be on your spouse, some may be on your family, your children, or your business partners. It takes time. It takes time to capitalize your system. It takes time to build wealth that will last. So the first priority should be on security, protecting what you've already saved and protecting your family in the event that something happens to you, the breadwinner. So now you've applied for your human life value, your economic value. This is something that should last you through your lifetime. All of it may not be used for infinite banking, but hopefully we're developing a strategy that you can utilize over your lifetime. There's different schools of thought on how you will accomplish these goals, solving for finance or solving for protection. So there has to be a balance somehow, somewhere. Just understand that life insurance at its core is for protection. It's to protect your family in the event of loss. So you don't want to come up short now or later, especially if your health changes in the future. This is one of the benefits of working with a mutual carrier. You can purchase term insurance that is convertible without evidence of insurability in the future. I like to have these policies separated so you can choose the amount and the time on your own, depending on your age, your health, and your available cash flow. You can also add this term insurance as a rider on a policy, but this creates more problems, risk down the road. So perhaps you're not ready to convert and the term premiums are increasing, then this could cause a problem. It could cause problems with the MEC guidelines. It could also cause problems with you losing the death benefit when you still need it, when you have children at home or your health may change. So it is a balance. You'll have to determine this on your own with your agent and find out what's most important to you and your family. In our example, I'm going to be working with a whole life insurance policy only, not term insurance. The term insurance may be, again, for later convertibility. And in my experience, over 20 years practicing IBC and working with clients, I will say that many people stop short. They do not think long term. And health does change. Accidents happen, life happens. So I encourage you to get your economic value over your lifetime. This will be important also if you have a traditional retirement plan to help you buffer that plan if there are market risks, if things change in the future, which they are likely to do. So if the objective is to create another stream of income in the future, the death benefit will weigh heavily at that point. You can certainly use policies for cash flow, and you can do it by surrenders or by loans. This again will be something we'll cover later, and you can determine later because your life will change. The main point I want to get across to you is that this is a different way of thinking. It's not what you've been taught in school. It's not what you've learned about life insurance, most likely. And so, as Nelson says, it's a paradigm shift, a way of thinking differently, outside the box, if you will. Most probably the reason you've considered this is you want to take control. You want your money, your capital, out of the hands of the government and the financial institutions. So that's really what it's all about, taking control. With control comes responsibility and accountability. You have to be accountable. You have to be an honest banker. And we'll get further into that in the future. But just understand your behavior in treating your system will determine the outcome. And also understand you really can't mess this up. Life insurance has buffers. It is a solid financial product that's been around for centuries. So if you have participating whole life, dividend paying whole life insurance from a mutual carrier, it's really hard to mess it up. It's a foolproof way to protect, save, and grow your wealth. Infinite banking is a strategy, is a concept, and it's a way to take control of the banking function. So you can control the financing over your lifetime, which can help you recover transfers of your wealth to taxes, interest, and fees. So you're thinking long term. You know you have to capitalize your system. You have to put money in the system to develop, to build, to grow your own privatized system. Consider this the process. It's a process of banking. It's not about the product of life insurance. We're not investing in a stock or mutual fund or crypto or real estate or anything else at this point. We're simply trying to build capital. You can fund this through your paycheck or any other means of cash flow that you have. This, of course, will be up to you where you get the money. Some agents may help you find the money through money that you would normally transfer away to taxes, interest, and fees, and help you recover that money to use, to prioritize, to capitalize your privatized banking system. In another video, I'll discuss how you can actually implement the banking process, how you may be able to use it. But in this video, we're going to focus on the strategy and the funding and how you may determine where to start. Where you start is simply up to you. Your agent, your practitioner may advise you, but understand you're becoming the banker. What I've learned over 20 years of doing this is that every situation is different. Many people have regular W-2 type jobs and they anticipate raises, increases in pay over their lifetime, and they're probably saving in some other form. And usually it's investing in a 401k or an IRA, a Roth, or the like. So this is not to be a substitute for that. This is in addition to whatever other means of investing or savings that you're doing already. It's to complement those other assets to make them even better. And over time, you may use the cash values, the cash flow from your system to invest in other assets to grow your wealth even more. We'll let compounding impact the growth of your system. So this takes time. So today we're looking for a starting point. Where do you start? There are many assumptions to be made, so I can only focus on one in this video. We'll start with an all-American male who has a family, children at home, married, 35 years old. We'll assume this individual is making $120,000 a year from his W-2 income job. Now, if you want to solve for finance, you also have to understand the problem. The problem is that we finance with other banking institutions. So the first rule you must understand is that we finance everything that we buy, meaning our capital has a cost. We either earn interest on our money or we pay interest to someone else for the use of their money. Many people get caught up in the interest rates, but the rates are relative. We cannot control the rates. But what we can control is the funding of our system, how we capitalize our banking system. And it is the volume of interest that we will pay over our lifetime to other banking or financial institutions. And it's important to understand that you're not comparing this to your other investments. We're not comparing the yield of the life insurance, the yield of your system. What we're doing is controlling the banking function. So we have to start somewhere. Let's look at spending pattern. Now, without getting too much into your budgeting, I just want to encourage you to take a look at how your money flows. Typically, we get paid and the money goes into someone else's bank. It either is direct deposited or we take the check to the bank. They want you to store your money with them. They want you to keep your money with them as long as possible. And they want to control your money. And they'll also offer to loan you money based on your collateral that you have invested, saved at the bank. If you just pay attention, your car, your home, all of these things the bank offers financing for. And again, the interest rates are all relative. We don't really have control over this. What we do have control over, though, is the volume of interest that we pay. Who will we pay the interest to? That's the beauty of owning your own private banking system. You can repay loans back into your system. So the capital is then available to you again when you repay the principal. The interest is paid to the insurance company. The life insurance company manages this system for you. You don't have to hire an accountant. You don't have to get QuickBooks. You don't have to hire an attorney. The hired help at the carrier, the company, will do this for you. And built in to a whole life policy, a traditional whole life policy that's been around for centuries, you have the ability to make loans against your cash value collateralized by your death benefit. So think about that for a moment. The people that own the mutual life insurance company are the policy owners. This means that they have first access to the capital. This is all outlined on page 26 of the book, Becoming Your Own Banker. That is the 5th edition. When seeing Nelson Nash live, he would always speak of imagination. And as Einstein famously said, imagination is more important than knowledge. It really boils down to how much control you want over your money, the banking function, over your lifetime. Your money will flow, and the question is, do you want it to flow through your system or someone else's? So this flow of money must come from somewhere. We'll call it a reservoir, a tank, a place that your capital is stored. So your money has to reside somewhere. Someone, some organization, some financial institution will be in control of this money. You can think of this as a business. You are the business owner. Every time you start a new policy, a new contract is issued where you are the owner. And as the owner, you have the right and the ability to control the cash flow in and out of this system. So as a business owner, you have to think about profits and expenses. I will tell you that you don't have the headaches that you do with a normal business. You don't have to hire employees because the life insurance company's already done that. Nelson calls them the hired help. You don't have to find a location because the policy, the contract, is the location. It is stored with the life insurance company. And these mutual companies that we work with have been around for centuries, most of them well over 100 years, many of them much longer than that. And they're pretty good at managing capital. They have actuaries, engineers basically, that build these policies. They can look down the road. They are already thinking long term, not next month, not next year. They're thinking a century down the road. So it's not going to cost you a lot of money to go into business because you're starting a banking business, your own family banking system. And the objective of the business should be to provide you with financing and possibly a stream of income in the future. With a normal business, you'll have to think about transferring that business either to the next generation or an exit strategy where you could possibly sell the business. With that comes a lot of headaches, cost, and with your own insurance policy, life insurance contract, you can simply transfer this tax-free to the beneficiaries. Nelson didn't like the word retirement, but let's face it, most people have a job and they are looking down the road at retirement. Retirement was a government term created to force us out of the workplace. But if we think about that, when we stop working, that's when we tend to get sick and, possibly even die too early, soon. Most of the people that live long lives work in some capacity, they stay active for the rest of their life. So even if you do have a normal job, possibly you want to consult or do some volunteer work or continue to be active throughout your lifetime. And so we're going to take that on out to age 95, back to the traditional family, starting at 35. We'll think in 10, 30, and 60 years down the road. The good news is because you're going to set your system up with you as the owner, you will control the contract. That means you can determine the beneficiaries, the heirs, who will receive the death benefit when you're gone. And you can utilize this contract, this system over your lifetime for financing. If you want to finance your automobiles, you certainly can. If you want to finance other investments, you certainly can. If you need this for cash flow, you certainly can. Nelson makes the examples in the book of financing automobiles and other major purchases. These major purchases could be college education. They could be starting a business. These are all up to you. It could be inventory. It could be inventory for your business. It could be purchasing capital equipment. It could be a roof on your house. These are all considered major purchases, things that you may not have the ability to pay cash for. All right, let's take a look at that all-American male who's 35 years old. He's earning $120,000 and he's going to get no raises in this scenario, and we're not going to consider any returns. We're simply looking at this over a 30-year time period, assuming the government retirement age of 65, which is what the underwriters are going to consider. So that's 30 years times $120,000, and that will give you $3.66 million. If someone has consistent income and is saving money, the underwriters will probably have no problem issuing a policy for $3 to $4 million. So of course we have to make assumptions, and we're assuming this person is at least reasonably healthy. So age, health, and income, net worth are all factors when applying for life insurance. So you know you need to save money for the future. The question is, how much do you want to save into your banking system? You have to capitalize your system. Many people want to stick their toe in the water, and that's fine. Just understand the less you contribute now, the less you'll have in the future. This is not get rich quick. It takes time to capitalize your system. For most people, that will be 3 to 7 years, depending on how aggressive you are in the beginning. Most people are blindly investing into mutual funds or stocks that are inside a government qualified plan, like a 401k, 403b, SEP, IRA, or the like. It's funny, few people are concerned about losses in these plans. But when it comes to something like life insurance, which again is a product of an insurance company whose job it is to protect you from risk, they get a little shy. So think about investing has risk. Savings is safe. It's secure. You don't have to worry about losing your money. So there are many ways to save into a whole life insurance policy. Since we're focusing on infinite banking, I'm going to show you a real easy design that doesn't have to be complicated. Our recommendation is to have a policy capitalized at least 6 months of income. In other words, you have a reservoir, you have additional savings in your collateral capacity as cash value. Think of it as an emergency fund. If life can happen, it will happen. I know this personally. So make sure that you set up a repayment schedule, but you're the banker, so this can be on your terms. So let's break it down. There's base premium, and then there's paid up additions riders, PUA riders for short. Now, every company differs on this. Some have a more flexible PUA rider than others. But at the end of the day, it's all premium. So on new policies and even on old policies, it's important to review your policy every year with your agent. You want to find out the MEC status. You want to find out if you want to continue contributing to the PUA rider. You may have to back off your contributions because of the MEC limits. This is another reason I don't like adding the term rider onto your policy. What it does is allow you to put more death benefit in the policy. But the flip side of that is that death benefit will go away unless converted. And if you do convert, well, then you may have a MEC problem on the original policy. So whatever premium you decide on for funding, you should stick with that premium, I would say a minimum of 5 years. If the carrier you work with has a flexible PUA rider, you may be able to adjust this up or down. So at the end of the day, just understand that a term rider and a PUA rider add complexity to the policy. If you're disciplined and you're accountable and responsible, this won't be a problem. But if you're the kind of person that likes to set it and forget it, well, you may have some issues later on down the road. Now, I don't want to overcomplicate things in this video, so let's keep it real simple. We're going to have a base premium and a PUA premium snuggling up to the MEC guidelines. MEC stands for Modified Endowment Contract. It's an IRS ruling. So if the government, the IRS, is trying to tell you how much you can put into a life insurance contract, that's a good thing. Just realize that the life insurance has been around longer than the IRS. And so this ruling came into effect after the TEFRA and DEFRA laws, as qualified plans, mutual funds, the like, were created in the 70s and 80s. So if you have a term policy as a separate policy, you can convert this typically without evidence of insurability. This again depends on the carrier. Again, if you're working with a mutual company and you convert it to a participating whole life, that will usually be convertible for 5 to 10 years. And in some cases, you may be able to extend that term insurance with a rider so you can convert it for maybe 20 years. Understand that the term rider, along with adding complexity, if it's added to a whole life policy, to help you increase PUA premiums, understand that that causes more risk for you, more risk for the insurance company, and more complexity. So if you really want a policy like that, my colleague jokes, well, get an IUL policy, because that's what they are. So traditional whole life policies are generally pretty safe. They come with real guarantees. They're guaranteed to grow every year. A term rider is going to add a cost, just like even a separate term policy, but you don't want that cost dragging down your policy if you can. So I don't want to make it any more complicated than it is. Just understand you have a base premium, you have a PUA premium, and you may want to add some riders, waiver of premium for disability, long-term care riders. There's many riders you can add to a policy. As your cash flow changes, increases, or maybe you receive windfalls, then you can convert more insurance to whole life. All of your policies may not be designed the same way. I find that people, as they get older, tend to want things much simpler. So whatever you choose, just understand that if you have a convertible term insurance policy, you can add on to your system in the future. Ultimately, when you get to that passive income stage of life where you're no longer working for a paycheck, maybe you're doing some side hustles or part-time consulting, whatever you may be doing, your life insurance can then be used either as income or to buffer against market downturns and other risks that you may find in the marketplace. That's the beauty of whole life insurance. It's going to grow over your lifetime, and 10, 20, 30 years down the road or longer, it's going to be performing really well. As the dividends accumulate, paid up additions compound, then you're going to see really strong growth in your latter years of life. And that's when you may need things like long-term care. So your policy could be used for long-term care. Most policies these days contain a accelerated benefit rider anyway, critical care riders. They're called different things with different companies, and there's no cost for these. So that may be more economical than buying a long-term care policy. Not that this is a replacement, but most people do not forego the cost for long-term care insurance. If you can, if that's in your budget, then certainly that may be important as we see more and more people getting sick in their latter years. But the good thing about these policies designed the way I've described is you can access the cash value at any time for any reason without any excessive paperwork, as Nelson called it, Mickey Mouse paperwork. You don't have to qualify again. So that's why it's best to go ahead and qualify in the beginning for your economic value, your human life value, so you never have to worry about it again. If your health changes, any of that, you don't have to worry about qualifying for loans. Whatever is available as your cash value, that's what's available for loan, minus about 5, maybe 10%, depending on the company, depending on the interest rate. But if the loan rate is 5%, then you can typically borrow 95% of your cash value. So there you have it. How to fund and structure your first infinite banking policy the right way, so you can get maximum cash value in the early years.